Good morning, everybody. So we will start our webinar. This session is for clearing our doubts in the introductory module. I guess all of you must have gone through the videos of the E-NCCMP course. Yeah. So I would request all of you to put in your questions one by one in the chat window so that I can start answering them. Am I audible to all of you? So please put in your questions in the chat window so that I can answer those questions. We had also shared a Google Sheet with you wherein a few questions we had asked you to put in your doubts. So students, I am waiting for your question. Please type in your doubts in the chat window so that I can answer them one by one. Okay, so here we have the first question by Prashant. He's asking that how does a share's total value as on date viewed? Prashant, we can see the value of the share is basically the price, current price as on date. Yes. So to view the prices on the share, we have different websites. For example, the NSEindia.com, or we can have a look at the prices on Money Control or BSE India, where we can see the prices of different share. These prices are live and they keep on changing on a continuous basis when the market is on during the market hours. I'll just show you how do you see it. If we open, say, www.nseindia.com, we can have, if we have a look over here, we can click on equity and say we type in any company's name, say Reliance Industries. Or say Reliance Power. So we can see the last quoted price of Reliance Power was 47.9 rupees. Okay, am I clear? We have the next question. That is, what do we mean by reverse book building process? Okay, so let me answer this. We are all aware that whenever a company comes out with an IPO issue, what do we mean by an IPO issue? IPO is an initial public offering where the company is issuing its shares to the public for the very first time. Yeah. So whenever a company comes out with an IPO issue, it can do that by two processes. One is the book building process and the other is the fixed price process. Okay. Now in a book building process, the company is actually trying to discover the price, the equilibrium price at which people want to subscribe to that issue. The company comes out with a price band, say a minimum price which is known as a floor price, and the ceiling price, that is the maximum price where you can bid for those shares. Now the number of bids which is received, the highest number of bids which has been received at a particular price, that is actually decided as the cutoff price. That means the price at which the shares would be actually issued. Okay. Now coming to the reverse book building, it is absolutely opposite of book building process, where the company is trying to buy back its shares from the public. It is basically trying to, through book building issue, it has issued its shares, it was selling its shares to the public at a particular price. In a reverse book building process, the company is trying to buy back those shares from the public at a particular price. Accordingly, the company will be deciding a ceiling price and the floor price, that is a particular price band at which it is comfortable buying those shares from the public, and the number of shares, the highest number of shares which has been offered at a particular price is set as the cutoff price at which the company finally buybacks its shares in a reverse book building process. So we understand in a book building process is used in an IPO when the company is trying to issue shares or sell shares to the public, whereas a reverse book building process is when the company is buying its shares from the retail public. Am I clear? Am I clear on this topic? Mr. Bhattwaj, am I clear? Okay. So coming to the next question, I have by Mr. Prashant, that how to analyze that current market price or bid price of an IPO is on the higher side or on the lower side. That is how to value a share of an IPO. Okay. So now to analyze an IPO, whether we should be investing in this particular company or not, there are a certain few steps which we need to follow. Once we carry out all those steps, then it is clear whether the price at which it is offering us or not, should we go ahead or not. So let me just pen down a few of them. So the first thing which we would like to see whenever an IPO issue is coming out is whether what is the business model of the company. Suppose a company XYZ comes out with an IPO issue, we should first see that what is the business model of the company. What is the company doing? Which company am I actually considering my investment? So there are certain more points which we should see which will give a clarity on the business model. For example, we should see the forecast of the industry in which the company is operating. So you have to do an industry analysis. Okay. Second, you have to also check whether the business in which the company is operating is unique and whether it has a longer sustainability or not. So we should check the sustainability and uniqueness of the company. The last but not the least, we should definitely check the scalability of the company's operation. That how much is the business model scalable and what are the growth opportunities for this particular company. So once we analyze all these three, we understand what is the business model of the company. The second and the most important aspect of any IPO which needs to be considered is the object of the issue. Now, what do we mean by the object of the issue? If the company is issuing shares to the public in return of some money, we should know that what is the usage of this fund which will be collected. If we are investing in a company, we should know that where our funds are getting into use. So the object of the issue should be crystal clear in our minds and we should relate to it before investing in any IPO. The third point which we could see while investing in an IPO is the management. We should check who is the management of the company and their track records. Now, how do we check the track records? We can check the track record of the management by looking at their educational qualification, also the performance of other group companies if the management is owning. We can also check on any kind of criminal cases or any civil cases which has been lodged against them. So if we check on all these data, we get a rough idea about the management of the company. Now the fourth point, which is again important, is we should look at the financials of the company. So we should do a detailed analysis of balance sheet, PL account, statement of profit and loss account, and we should also look into the different ratios. By doing all these, we get a brief idea about the financial condition of the company. We could also check on the EPS and dividend, if the company is being giving the dividend or not steadily. So once we go through all of these, we get a rough idea whether the company we are trying to invest in is may offer us good returns or not, and henceforth decide whether we want to invest in it or not. Important thing to note is that all this data about the business model, the object of the issue, management, financials of the company, all this data is available in the offer document when the company is issuing a share. Am I clear? Am I clear, Prashant?
Okay.
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 So moving on to the next question, we have another question which is by Avni, that she wants to understand what do we mean by a stop loss order. Okay. So let us move on to the next question, which is the stop loss order. Okay. Now, first let us understand the concept of a stop loss. What do we mean by a stop loss? Yeah. Take for an example, if we enter into any kind of a position, be it an investment position or a trading position. Say I buy, Mr. X, say buys 100 shares of, say, Reliance, or say Tata Steel at, say, 300. Okay. So now as the price is increasing, Mr. X earns, and as the price starts falling, if the price of Tata Steel starts falling, Mr. X starts incurring a loss, right? Now, since prices are unpredictable and can go in any direction, whenever we are entering into any kind of a trading or an investment position, we should have a stop loss on it. That means we should decide before entering into the trade that this is the maximum loss which I will incur on this particular trade, otherwise I will exit. So for example, Mr. X decides that he will be taking a maximum of 1000 rupees loss on this particular trade. Okay. So if he is ready to bear a maximum of 1000 rupees loss, so what is the per share loss which he can incur on a share of 300, which is 10 rupees. So if Tata Steel falls by 10 rupees, if Tata Steel goes to 290 rupees, Mr. X will be incurring a 1000 rupees loss, basically 10 rupees per share into 100 shares which he owns, which comes to 1000 rupees. That is the maximum amount which he is ready to spend on this particular trade. So 290 rupees is the level of stop loss which has been decided by Mr. X. So if the price of Tata Steel goes below 290, he will be exiting this particular position. Now, in order to do that, he needs to put on something known as the stop loss order. How does he put that? So, in a stop loss order, you have basically two fields, one known as the limit price and one known as the trigger price. Okay. So, when you put a stop loss order, in this particular situation, he has to sell the Tata Steel shares if the price goes below 290. That is our case, right? So he will be putting a sell order of Tata Steel of 100 shares, that is the quantity, if the price goes below 290. So the trigger price is 290. That means your order is triggered into the system when the Tata Steel price trades at 290 or below. So once your trade is triggered, your stop loss sell order is say 289.8. Okay, so you have placed an order into an exchange that sell my 100 shares of Tata Steel at 289.8 if Tata Steel is trading below 290. That means your order gets triggered into the exchange when the price of Tata Steel hits 290. Am I clear? Avni, am I clear? Okay, thank you. Coming to the next question, that is exit load. What do we mean by exit load? Okay. So there are two concepts, entry load and exit load, with respect to mutual funds. Now, whenever you are investing in a mutual fund, the mutual fund actually charges you some commission. Suppose you have invested 100 rupees, which has grown to 120 rupees. When you try to redeem that investment of yours, you need to pay in a small brokerage fee, which is known as an exit load. The fee which is being charged at the redemption of your investment by mutual fund is known as the exit load. Am I clear? Okay, we have another question, that is, what are the stages in a share's life cycle? How is a share issued, share capital, dividend, bonus, split, right, etc. Okay, now Prashant, shares are issued the very first time when the shares are issued. It is known as an initial public offering, where the shares are issued at a face, shares are listed in the balance sheet, stated in the balance sheet at the face value, which is comprising of your share capital. Number of shares which is being issued into the face value of the share is known as the share capital. Okay. Now, once a company has issued the shares for the very first time, those shares are now available for trading in the secondary markets. That means transfer of ownership is possible only through secondary markets. So we have exchanges like the NSE India or BSE India, where share trading is possible, and which is traded, and the transfer it provides liquidity to the existing shares. Yeah. Now coming to dividend, bonus, split and right. Dividend and bonus, split, rights, these are all different kinds of corporate actions which is being decided by the management of the company and the board of directors, and it is completely on their discretion whether they want to announce these kind of decisions, such as dividend and bonus, which is purely depending on the profitability of the company. If a company is incurring profit and it doesn't have too much to invest in any other project, it might probably announce any dividend or a bonus. Stock split is again a corporate action which is decided by the management and is done to enhance the liquidity of the existing shares. The face value of these shares are split. And right issue is an issue, again, is a way of collecting funds. It is a fund generating project by any company where the existing shareholders are given special rights to apply to those shares at a discounted price. Am I clear, Prashant? Okay, so coming to the next question by Farhad, that what decides the fluctuation in share prices on a daily basis? Now, price is basically a function of demand and supply, as we all know. So, and demand and supply on a constant basis is changing for these stock prices. So, normally, whenever a share trading is on an exchange, continuous bids and offers are applicable on these shares. People are constantly bidding to buy the share and people are constantly asking, uh, offering shares at particular different prices, right? So the moment a bid and an ask is matched, a share trade takes place. So the price is fluctuating on a constant basis based on these bids and offers, which again is a function of demand and supply. Am I clear, Farhad? Okay, so we have another question, that is, how do we find out which mutual funds are performing better? Now, there are various mutual fund websites like amphi.com and different magazines where continuously these mutual funds are recording their NAVs. These mutual funds have a NAV, which is the net asset value. They come out, they publish their NAVs daily, and looking at their NAVs and their performance, you can understand or you can judge which mutual fund is performing better or not. There are different various magazines also which come out with a complete performance and analysis about different mutual funds, which you can have a look at. Shreya, the questions which you are asking is probably not in context to this particular module. You could raise these questions in the Ask Me Doubt query and we will answer them separately. These questions are not in context with the introductory module of the E-NCCMP program, so would probably not be discussing them right away. Okay. Yeah, we have certain websites to track these, that is amphi.com, AMFI. You can also get on myiris.com or Money Control the performance of different mutual fund. Please check your mic settings. Okay. Any other questions? Okay, there's another question. I hope I'm audible to all. Yes? Okay, moving on. So there is another question by Shreya, that are there any predetermined number of days between dividend declared date, X date, record date and dividend pay date? Shreya, normally there is no predetermined number of days. These dates are discretionary, decided by the board of directors and the company management, which is been intimated to the exchange. So the board of directors only decide these different dates and they inform the exchange, which is then published to the retail public. Am I clear, Shreya? Okay. Waiting for the next question, please. Okay, so we have another question by Kanan, that why currency is called an underlying security. Kanan, again, currency is a type of an asset, right? So any asset we normally call an asset who has a derivative contract as an underlying security. So we have derivatives contract on different currency pairs, hence they are called as an underlying security because the contract underlying is the currency pair which is being traded. Okay, Kanan? Okay, for example, if we look at, say, USD INR futures contract is, say, being traded at 65 rupees. Okay, so if we look, if this is USD INR is, say, 65 rupees, which is the spot value. Okay, it is the spot value of USD INR is 65 rupees. Now 1 month futures contract, if we look of USD INR is, say, 66. That means this contract, this is a derivative contract which is deriving its value from this spot underlying asset. Okay, USD INR futures contract is deriving its value from the spot rate, hence it is known as an underlying asset or an underlying security. I think I'm not audible. Please check your mic settings. Please check your mic settings. Is everybody, can everybody hear me? Please type in a yes so that I know that you all can hear me. Please type in a yes quickly. I think most of you all can hear me. Who cannot hear me? Prashant, can you hear me? Anuj, can you hear me? Anuj Dhawan. Archa, can you hear me? Okay, so I think we'll continue with our session since most of you can hear me and there is no problem here. So coming to the next question, that is by Farhad. He is asking, is an IPO open for general public and how do we come to know if such an IPO is under offering? Farhad, yes, an IPO is open for general public and we have advertisements of the same in the newspaper, also in the TV channels, also on the NSE website or the SEBI website. You can have a look that if there is a particular IPO which is coming up. So any business newspaper, business channel will be having details and the dates of any upcoming IPO. For example, the last IPO, the recent IPO which came was of Infibeam, and it was there in all the business newspapers as well as the business news channel. Okay, Farhad? Okay. Coming to the next question, that is, what do we mean by the interval period in an interval fund? That is the next question. Now, interval period, as we all know, is interval fund is all with respect to a mutual fund. A mutual fund, which is an interval mutual fund, is basically a combination of a close-ended mutual fund as well as an open-ended mutual fund. So it is basically performing as a open-ended mutual fund for certain period of time, and then it acts as a close-ended mutual fund for specific time. The difference, the time gap between the open-ended mutual fund and the close-ended mutual fund is known as the interval fund. Okay. Okay. So there's another question by Mr. Bhardwaj, that who are the promoters and in which category do the general public come in? Okay. So the promoters are basically the management of the company who is running the company, and the general public comes in the retail participant or retail public category, the retail category of any issue. Okay. Next is a question that how does the stock split reduce the stock price? Okay. Now Shreya, let's understand this with a simple concept. Let me just say share price is listed, say 1000 shares. This is a balance sheet of the company. I'm just giving an example. Okay. And the face okay. Now let us understand this share capital. So in the balance sheet of the company, if we have a look, the share capital, this is the quantity of shares which is being issued, which is 1000, and the face value of each share is 10 rupees, and hence the entire share capital of the company in the balance sheet is say 10,000 rupees. Now the current market price of this share might be say 2500 rupees in the market per share. Okay. Now since the value of this share is high, there might be liquidity issues with this particular share, that the company might not be having enough volume. So company probably, the management probably might decide to reduce the share price. Okay, how? It will simply do 2000 shares of 5 rupee each. It will be basically splitting this face value of the share into two. A 1:1 split will create the existing face value to 5, and the number of shares which has been issued will simply turn to 2000, remaining the share capital value will be the same. So there is no change in the face value of the share, but the number of shares has been increased. So automatically, if an investor is holding say 100 shares of this company at 2500, will now be holding 200 shares of 1250. Hence the stock price has been reduced by the stock split. Am I clear, Shreya? Okay. So coming to the next question which we have, that is, what is tick price and what is tick size? Okay. Now tick is the minimum change which the price in which the price will fluctuate. So for example, if a stock is trading at say 100 rupees, okay, and the minimum tick size is say 0.5, that is 50 paise. So the minimum change, the next change of this stock price will be either 100.5 or 99.5. Okay, so if 0.5 is the tick price or the tick size, if tick size is 0.5, so the next change will be in multiples of this tick size. Okay. Prashant, there is no ideal shareholding pattern. It differs from case to case. Okay, so we have okay, so in context to the similar topic, we have a question by Utsav that will a company be benefited in bonus or stock split? No, there will be no benefit to the company when a company is announcing a bonus. It is a reward to its existing shareholders by giving out free shares. Okay, so the basically in the balance sheet also, the amount from the reserves and surplus is simply transferred to the share capital, and its equity share capital is increasing. Even in the stock split, the balance sheet value, there is no change from the company's point of view, but yes, It does enhance the liquidity of the shares, so more trading in the secondary markets takes place whenever a stock split is announced, which will attract more volumes and more trading. Okay, so we again have another question regarding what happens to the delisted stock. It remains in the balance sheet of the company, but it is stopped from trading. You can't trade on the secondary markets if a stock is delisted once. However, those shares will be there in the balance sheet of the company. Okay. Now coming to demerger, we again have a small question that what is the demerger of a stock? In a demerger, a company, say a company X is into, say, several business. Say if we talk of Reliance earlier, so Reliance was into power, Reliance was into telecom, Reliance is into capital raising, say mutual fund, okay, and Reliance is into oil and gas, okay. So earlier there was only one Reliance, so one Reliance company is actually operating in all different fields, right? Now through a demerger, what a company can do is make these different these different business into different separate companies, hence it goes in for a demerger. A company demerges and one big company splits into smaller companies. Okay. Any other questions from the introductory module? Attendees, you can also unmute yourself once and ask the question in case if you want, or any other questions, please type in the chat window. Okay, so I'm assuming that all the questions and doubts has been cleared. Okay, we again have another question. Just a minute. Okay, so we have another question that what do we mean by hybrid funds? Now, Utsav, hybrid funds are again a type of mutual fund which invest in equity capital as well as in debt capital. Okay, so a mixture of both equity and debt capital is known as a hybrid fund. It gives us certain amount of capital appreciation as well as capital protection. Okay, Prashant, if you are looking for any particular book to read related to markets, I would suggest 2-3 things to get yourself updated. First, we have a YouTube channel of eLearn Markets. Please get yourself registered on the YouTube eLearn Markets channel. There are continuous updates on the markets over there. You can subscribe to the channel and have a look. Also read our blogs regularly, which is being posted. And third, there are a few books like Once Upon Wall Street by Peter Lynch, and there are other books which you can read about the markets. So I think we can end this session. Any other questions, please? Advait, didn't get your question. Beginner's Guide to Investment. Didn't get your question. Could you please elaborate? Okay, so I think we can end this session now. There are no more questions related to the introductory module of the E-NCCMP program. I am Suchi Rungta, and for any further queries, you can always put your doubt in the Ask Me Doubt tab below every video, beside every video, and we will be answering that. You can also raise your questions in the WhatsApp group, which you all are already added, and all your queries will be solved. Okay? Thank you for now. Bye.